What is the best investment strategy for you? Is it investing your money in stocks, bonds, mutual funds or real estate? Most people who are new to investing think they have no idea what they're doing and end up with a weak portfolio that doesn't grow their money at the right pace. Investing is one of the most important financial goals you will set for yourself. It can also be one of the most confusing if you don't know where to start. After all, how do you know which type or combination of investments is right for you? What factors should be taken into consideration when choosing an investment strategy? That being said, there are many ways to invest your money that can pay off handsomely later on down the road. Here are some of the best investment strategies available today. What is an investment? Simply put, investing is using your money to earn money. It is not the same as working for a company. When you work for a company, you receive a salary and are given a set amount of hours to work. When you invest, on the other hand, you do not directly control what happens to your money. Instead, you give your money to someone else who then has complete control over how to use it. This can be a financial advisor or a fund manager who will decide the best way to invest your money. This is important to understand because many people make the mistake of thinking they can control their own finances and choose which investments to make. In fact, this is one of the biggest mistakes you can make in investing. You simply do not have the capacity to decide what to invest in or when to make investments. The market will set the direction for your investments. How to invest in stocks. This is perhaps the easiest way to invest your money. Stocks are owned by companies that produce goods and/or services. If a company makes an attractive product, the demand for it will increase and the stock price for that company will go up. You can buy stocks by going to a stockbroker and making an offer to buy a certain number of shares at a certain price. Bonds and debt securities. Bonds and debt securities are loans that are issued as certificates of ownership. They are similar to stocks in that they are also ownership shares in a company, but they differ in that they do not represent a direct stake in the company. Instead, they are certificates that give the holder the right to receive a predetermined amount of interest at a fixed rate of return. Mutual funds. Mutual funds are similar to stocks in that they are ownership shares in a company, but unlike stocks, they are pooled investments of money from many people. Investment professionals buy a certain mix of stocks and then buy enough shares in companies that those shares are then held by thousands or even millions of people. The best overall investment strategy. As we discussed above, there are many investment strategies to choose from. To help you make an informed decision, let's go over what we think is the best overall investment strategy. This is a balanced approach that will help you achieve diversification and reduce risk while offering you the highest possible return on your money. First, you need to understand that you are not smarter than the market. You are just putting your money to work with someone else's money. What you can do, however, is make sure you're investing wisely and following an overall strategy. When it comes to the overall strategy, there are a few things you want to keep in mind. First, you want to be conservative with your money. You don't want to be all over the place and jumping into new things every week. You also want to make sure you're following a sound investment strategy. You don't want to be investing in things you don't understand. You also want to make sure you're diversified. You don't want all of your money in one place or all of your money in one type of investment. The best overall investment strategy is a balanced approach that includes the following. 1. Stocks. 2. Bonds. 3. Real estate, rights. When it comes to stocks, you want to be investing in companies that are solid and growing their earnings over time. Ideally, these are companies that are growing their earnings faster than the average company in their industry and have a competitive advantage over others in the same industry, a moat. When it comes to bonds, you want to invest in high-quality bonds issued by governments or companies with strong balance sheets that have been around for years and have a history of paying back their debt on time and with interest. When it comes to real estate, you want to invest in real estate investment trusts, REITs, that own income-producing properties such as office buildings, apartment complexes, shopping centers, warehouses, etc., which should provide a steady stream of income for years into the future. This is why we recommend dividend stocks as well. They offer a nice combination of both capital appreciation and dividends paid out each year, which can help boost your overall return on investment over time while giving you peace of mind knowing your money is working for you. If you're looking for a good income stock to add to your portfolio, we suggest considering the following companies. AT&T, AT&T is one of the largest telecommunications companies in the United States, and it offers a wide range of communication services including landline telephone, wireless phone service, internet access, digital TV and video services. It also has strong exposure to Latin America markets and many emerging markets across the globe, which should help boost its growth as those economies continue to grow. Additionally, it has a strong balance sheet with zero debt and more than $13 billion in cash on its balance sheet. AT&T is expected to grow earnings at an average annual rate of nearly 10% over the next 5 years while paying out dividends that have grown by an average annual rate of 9% over the past decade. If you're looking for a good income stock with plenty of growth potential over time, AT&T may be worth considering for your dividend portfolio. McDonald's, MCD. McDonald's is the largest fast food restaurant in the United States, and it has a dominant market share of the fast food industry here. It has been growing earnings at an average annual rate of nearly 10% over the last decade, and it is expected to grow earnings at an average annual rate of more than 7% over the next 5 years. McDonald's also offers a dividend that has grown by an average annual rate of nearly 8% over the past decade, and it has increased its dividend payout by more than 5% per year over the past 5 years. If you're looking for a good income stock, McDonald's may be worth considering for your portfolio. Microsoft, MSFT. Microsoft is the second largest software company in the world, and it has a dominant market share in the personal computer software market. Over the past decade, Microsoft's earnings have grown by an average annual rate of more than 11%, and it is expected to grow earnings at an average annual rate of nearly 8% over the next 5 years. Microsoft also offers a dividend that has grown by an average annual rate of more than 7% over the past decade, and it has increased its dividend payout by more than 5% per year over the past 5 years. If you're looking for a good income stock, Microsoft may be worth considering for your portfolio. Starbucks, SBUX. Starbucks is one of the most widely recognized brands in America today, and it has been growing sales at an average annual rate of nearly 10% over the last decade. It is expected to grow sales at an average annual rate of nearly 6% over the next 5 years as well. Starbucks also offers a dividend that has grown by an average annual rate of almost 10% over the past decade, and it has increased its dividend payout by more than 5% per year over just about every time period I looked at, going back to 2008. If you're looking for a good income stock, Starbucks might be worth considering for your portfolio. Just remember that diversification reduces risk and helps your investments grow faster. When choosing a strategy, you want to be conservative with your money, so you don't get too excited about new investments.